And Dr. Allen Featherstone, the head of the Agriculture Economics Department of K-State, is our guest this week. And Dr. Featherstone, as we look at the kind of ag finance situation, we have a lot of numbers to dissect and piece together, but maybe let's talk about where these farms that you've been kind of following are from a liquidity standpoint, or from the ability maybe to be in a position to weather some of these storms.
Yeah, one of the measures that lenders often look at is the debt to asset ratio, and then they'll also look at a liquidity ratio to kind of get a feel. From a leverage perspective, we're in a pretty good shape at the end of 2019 in terms of, there's usually two cutoffs that lenders like to look at. One is the debt to asset ratio being over 70%. They view those farms as being vulnerable, and those with kind of that debt to asset ratio in that 40 to 70% as being marginal. One of the things that we find is that roughly 80% of the farms that we're following here have a debt to asset ratio less than 40%. And so those are in really good positions, and they do have the ability to essentially leverage and deal with a couple down years. Roughly 16% of those farms are in that 40 to 70%. Certainly they're in a marginal perspective there. You're going to have to follow their liquidity. You're going to have to follow their income. And again, if they're in the top half of profitability, they will still probably be in pretty good shape over the next couple of years. Those above 70%, roughly 4% of Kansas farms are above that 70% level. Certainly that's in a vulnerable area. Certainly those farms do not have the wherewithal to take very many negative years without making major restructuring of their balance sheet, perhaps selling some assets to retire some debt. There, I think you really want to look at the liquidity position and again, the profitability. Hopefully those farms will be in the upper quartile with regards to profitability. From a liquidity perspective, farms are in pretty good shape in terms of essentially over the last couple years, farms have built their working capital. Basically, working capital is kind of a measure of the current liability or assets minus current liabilities. And so the more working capital they have, the better ability they have to make those payments, the better ability they have to do some of the financing of their operating expenses from their own operation, as opposed to using lender finance. And so that position has actually improved the last couple of years. The other thing that we talked a little bit about in the presentation was basically looking at interest rates. We just completed a survey of lenders. We did the survey in May after the pandemic started. And one of the things there is that there's a lot less expectations of increasing interest rates. And so I think we're going to be in a position of fairly good interest rates from a lender or from a borrower perspective. And so in some respects, I think that will help producers maybe to get the financing at a reasonable rate in order to help them through this difficult time.
Well, Dr. Featherstone, always great to catch up with you and your insights on what's going on in the ag finance world. So, and again, folks, some more information on these and other things, agmanager.info. So thanks for joining us.
Thanks, Ken.
Dr. Allen Featherstone, the Department Head of Ag Economics at K-State, has been our guest. Stay with us. We'll have more in just a moment.